What if the UK economy is growing, yet most people are quietly falling behind? Wages rise on paper, but daily life feels tighter, not easier. Home ownership drifts further out of reach, savings shrink faster, and effort delivers less security than it once did. Meanwhile, wealth at the top continues to expand almost effortlessly. This gap did not appear overnight, and it is not driven by laziness or poor choices. It is rooted in how money, policy, and opportunity now move through the system. The question is no longer whether the economy is growing, but who it is really growing for. Number 1. Wage growth falling behind inflation. Over the past 5 years, wage growth in the UK has failed to keep pace with the rising cost of living, leaving many workers effectively poorer despite being employed. While headline pay figures show modest increases, real wages adjusted for inflation reveal a persistent decline for lower and middle-income households. Everyday expenses such as food, energy, rent, and transport have risen faster than salaries, quietly eroding purchasing power and financial security across large parts of the population. High earners, however, experience this pressure differently. Many in the top income brackets receive bonuses, profit sharing, or income linked to company performance that adjust more quickly during inflationary periods. Others supplement earnings through investments or business ownership, allowing their income to rise independently of basic wage structures. This flexibility means inflation acts more like a temporary inconvenience rather than a sustained financial threat for wealthier workers. The long-term impact is structural rather than temporary. When wages stagnate, households reduce savings, delay major purchases, and rely increasingly on credit to maintain living standards. Over time, this shifts economic resilience upward, concentrating stability among those whose income is insulated from price shocks. An economy where work alone no longer guarantees financial progress increasingly rewards position over effort, reinforcing the sense that rising prosperity is reserved for a narrowing segment of society. This imbalance subtly reshapes social mobility, as younger workers find advancement slower and riskier, while established earners maintain momentum through existing advantages entrenched within pay systems and labour markets nationally. Over time, confidence erodes, participation weakens, and economic optimism narrows for those living primarily on wages alone under persistent inflation-driven uncertainty across households. Number 2. Asset inflation rewards owners, not earners. Over the last decade, UK economic growth has increasingly flowed through asset values rather than wages, quietly reshaping how wealth is generated and preserved. Property prices, stock markets, and pension funds rebounded faster than household incomes after recent shocks. Those who already owned assets benefited from rising valuations, while workers dependent on salaries saw little direct uplift from this recovery momentum or policy-driven stimulus across sectors and regions nationally. The top tiers of society typically hold property, shares, and retirement investments that respond positively to inflation and market stimulus. Rising house prices increase net worth without requiring additional labour, while equity growth compounds quietly in the background. Renters and first-time buyers face higher deposits, stronger competition, restrictive lending, and reduced access to ownership, locking them into a cycle where rising asset values work against them financially and socially over time. This dynamic changes the character of the economy itself. Wealth accumulation becomes less about productivity and more about timing and access. When asset ownership determines security, opportunity tilts toward those positioned early rather than those striving now. Over time, disparities widen as gains compound for owners, while non-owners absorb rising living costs without equivalent protection. Asset inflation therefore acts as a silent amplifier of inequality, concentrating economic stability at the top and weakening the link between work, reward, and long-term financial progress for millions across the country and younger generations entering adulthood today. This shift, reshapes ambition, risk tolerance, family planning, and confidence, embedding inequality deeply into everyday economic behaviour and expectations for future generations nationwide, influencing policy outcomes, labour dynamics, mobility, stability, opportunity, resilience. Long-term effects persist. Number 3. Housing costs act as a wealth filter. Housing in the UK increasingly functions as a dividing mechanism rather than a foundation of stability. Rapid price growth combined with higher mortgage rates has made entry far more difficult for new buyers. Deposit requirements rise faster than savings, while lending criteria tighten. For many workers, especially younger households, home ownership now feels permanently delayed, regardless of employment or effort. Existing homeowners experience a very different reality. Those who bought earlier often sit on significant equity gains while benefiting from previously locked, low-interest mortgages. Rising rents improve returns for landlords, increasing income without additional labour. Housing therefore rewards historical access rather than current contribution, transforming shelter into a financial asset that compounds advantage for one group while excluding another. Over time, this imbalance reinforces inequality across generations. Wealth transfers increasingly rely on family support, inheritance, or location-based privilege rather than personal income. High housing costs also restrict mobility, forcing workers to remain in lower opportunity areas or accept longer commutes. As housing absorbs a growing share of income, spending elsewhere falls, weakening broader economic participation. When access to stable housing depends on timing and ownership, the economy quietly filters opportunity upward, concentrating security among those already positioned inside the system. Long-term consequences extend beyond wealth, shaping social confidence, family formation, mental stress, and risk tolerance. As housing insecurity influences career choices, entrepreneurship, fertility decisions, and retirement planning, slowly embedding economic divides into everyday life, expectations, and future prospects for households navigating an increasingly closed property ladder nationwide amid persistent shortages, speculative pressures, policy inertia, and rising population demand without meaningful reform or balanced regional development for fairness outcomes. Number 4. Tax structures favour capital over labour. The UK tax system increasingly advantages wealth, derived from assets rather than income earned through work. Employees face income tax, national insurance, and reduced allowances as earnings rise, while returns from shares, property, and investments are often taxed at lower effective rates. Reliefs, allowances, and exemptions allow those with capital to structure their finances efficiently, reducing overall tax exposure compared to workers relying solely on salaries. Wealthier households are better positioned to benefit from these structures because they have access to financial advice, diversified portfolios, and long-term investment vehicles. Income from dividends, capital gains, or property appreciation grows quietly while facing fewer immediate deductions. Meanwhile, workers see deductions before wages even reach their accounts, limiting their ability to save or invest at scale. This imbalance shifts the tax burden downward across the income spectrum. Over time, the difference compounds. Capital-based wealth grows faster while work-based income struggles to break free from taxation and inflation pressure. This framework changes incentives across the economy, encouraging asset accumulation over productive labour participation. Social mobility slows as financial security increasingly depends on ownership rather than contribution. When the tax system consistently rewards those who already hold wealth, economic outcomes begin to reflect structural design rather than individual effort, reinforcing inequality across generations and narrowing pathways for upward movement, weakening motivation, distorting opportunity, and hardening economic class boundaries within modern British society. These pressures influence behaviour, career choices, and savings habits, ensuring advantages remain concentrated while financial strain becomes normalized for those dependent on employment, income alone over time, across regions, generations, and households, facing reduced opportunity despite full employment and rising living costs. Number 5. Decline of public services hits lower incomes hardest. Over recent years, pressure on public services has become a quiet but powerful driver of inequality in the UK. Funding constraints affecting healthcare, transport, education, and local councils have reduced reliability and quality across everyday services. Long waiting times, overcrowded facilities, and rising user costs now shape daily life for millions, particularly those who depend most on public provision to maintain stability and well-being. Higher income households are insulated from these pressures because they can purchase alternatives. Private healthcare, paid tutoring, private transport, and fee-funded care replace services that once worked universally. This gap converts income advantage into quality of life advantage, widening inequality beyond wages alone. When public systems weaken, those without financial flexibility absorb lost time, stress, and missed opportunities that wealthier groups easily avoid. The economic impact compounds gradually. Reduced service access lowers workforce health, mobility, and productivity, creating hidden costs for lower income workers. Time spent navigating failing systems replaces time available for skill development or advancement. Over generations, unequal service access hardens social divides, reinforcing cycles where disadvantage multiplies quietly. When public services no longer act as economic equalizers, the economy shifts toward a two-tier structure, where resilience is purchased privately. This transformation benefits those already ahead while increasing fragility for others, making inequality feel inevitable rather than chosen, and embedding structural imbalance into everyday life across communities, regions, families, and working households, facing constant adaptation under rising costs and shrinking collective support systems nationwide today within modern Britain today. Number 6. High interest rates penalise borrowers and reward capital. High interest rates have reshaped the UK economy in ways that sharply divide households by financial position. For many working families, borrowing is essential to manage housing, transport, and everyday costs. Variable mortgages, personal loans, and credit card balances become more expensive as rates rise, increasing monthly outgoings without increasing income. This creates constant financial pressure for those already balancing tight budgets. Wealthier households experience the opposite effect. With a lower reliance on debt and greater access to savings, rising interest rates translate into higher returns. Cash savings, fixed income products, and low-risk investments pay more, allowing capital holders to earn simply by holding money. The same policy designed to control inflation therefore redistributes purchasing power upward, rewarding those with accumulated capital while draining resources from borrowers across the economy. This imbalance has broader consequences. As debt costs rise, lower-income households cut spending, delay milestones, and reduce economic participation. Demand weakens at the base of the economy while savings accumulate at the top, slowing overall momentum. Over time, interest rate policy deepens inequality by aligning financial stability with wealth rather than work. Borrowing becomes riskier, opportunity becomes narrower, and resilience concentrates among those least affected by rate changes. When monetary tools consistently advantage savers over strivers, the economy drifts further from balance, reinforcing a system where financial position determines outcomes more strongly than effort, productivity, or contribution, shaping long-term prospects for households navigating persistent high-rate environments without buffers or safety nets nationally today. Number 7. job market growth skips the middle. The UK job market has continued to expand in headline terms, yet the quality and distribution of that growth reveal a growing imbalance. New roles are increasingly concentrated at two extremes: highly paid professional positions and low-paid service work. For many workers, traditional mid-income roles that once supported stable lives have thinned out, offering fewer pathways for steady progression despite rising employment figures shown in official data. High-skill roles in finance, technology, law, and senior management command strong salaries and benefits, often concentrated in specific regions and networks. At the other end, sectors such as care, hospitality, delivery, and retail continue to grow, but wages remain compressed and working conditions strained. Workers stuck between these poles face declining bargaining power, fewer promotion ladders, and increased competition for roles that once formed the backbone of the middle-class economy. This hollowing of the middle reshapes economic outcomes over time. Without stable mid-tier careers, income growth slows and household planning becomes fragile. Workers may juggle multiple roles, accept insecure contracts, or retrain repeatedly just to maintain position. Economic security increasingly depends on reaching the top tier rather than building upward gradually. As the labour market polarizes, opportunity narrows for those without elite qualifications or connections. The economy may appear healthy on paper, yet beneath the surface it rewards a small segment disproportionately, while leaving many workers in a cycle of effort without advancement, reinforcing the perception that progress is reserved for those already positioned near the top, while broader resilience, confidence, and long-term mobility quietly weaken nationwide across generations, regions, households, and future workforce stability expectations overall nationally today. Number 8. Productivity gains do not reach workers. UK productivity has increased unevenly across sectors, yet the financial rewards of that output growth rarely reach average workers. Businesses benefit from technology, automation, and efficiency improvements that raise output per employee. However, wages remain weakly linked to these gains, meaning workers produce more value without seeing proportional income growth. This disconnect breaks the traditional link between effort, performance, and reward. Senior executives, shareholders, and investors capture most productivity benefits through dividends, share price appreciation, and performance-based bonuses. Workers receive fixed pay increases that fail to reflect rising efficiency. In many firms, productivity growth is treated as a margin-boosting tool rather than a reason to raise wages. Even when companies report strong profits, frontline staff often see minimal improvement in earnings, flexibility, or job security. Over time, this separation reshapes attitudes toward work itself. When increased output brings no meaningful financial improvement, motivation weakens and engagement declines. Workers may reduce discretionary effort or seek alternative income streams simply to cope. Economic growth then becomes top-heavy, driven by capital returns rather than shared prosperity. Productivity growth loses its social purpose, functioning only as a financial accelerator for those already holding ownership stakes. As this pattern repeats, inequality deepens quietly, with efficiency gains amplifying wealth concentration instead of lifting living standards broadly. The economy continues to grow statistically, yet fewer people feel connected to that growth in real life. This erosion undermines long-term sustainability, trust, and cohesion, reinforcing the perception that structural rewards favour position and capital, rather than contribution, skill development, or sustained work effort across modern British labour markets today. Number 9. Opportunity is concentrated by geography. Economic opportunity in the UK is increasingly determined by location rather than skill or effort. London and parts of the South East continue to attract investment, high-paying jobs, and infrastructure spending, while many towns and regions experience slower growth and limited prospects. This imbalance means two people with similar qualifications can face very different outcomes simply based on where they live, shaping income, mobility, and expectations from the start. High-value sectors such as finance, technology, law, and senior management remain heavily clustered in a small number of cities. These areas benefit from stronger networks, better transport links, and higher public and private investment. Meanwhile, former industrial regions struggle with underinvestment, fewer career ladders, and weaker employer competition. Relocating closer to opportunity is no longer simple, as housing costs in growth regions act as a financial barrier for most workers. Over time, geographic inequality compounds economic inequality. Areas with limited opportunity see lower wages, reduced tax bases, and declining public services, reinforcing regional stagnation. Younger workers either leave, draining local talent, or stay and accept lower returns on effort. Families become tied to postcode outcomes, where chance of advancement depends more on geography than ambition. This structure benefits those already positioned in opportunity-rich locations while quietly restricting social mobility elsewhere. When economic momentum depends on where you start rather than what you contribute, national growth loses balance. The result is an economy that works smoothly for a concentrated core while leaving large parts of the country operating below potential, increasing frustration, division, and long-term instability across regions and communities nationwide. This persistent divide shapes political sentiment, trust, and future cohesion. Number 10. Economic policy protects existing winners. UK economic policy increasingly prioritises stability for those already embedded in the system, rather than loosening access for new participants. Measures aimed at protecting housing markets, financial institutions, and pensions often take precedence over reforms that would reduce entry barriers. This approach limits volatility at the top, but leaves working households exposed to sudden changes in prices, benefits, or eligibility rules that directly affect daily life. Those with assets benefit from policies designed to avoid market corrections, especially in property and finance. House price support, bank protections, and cautious reform delays preserve existing wealth while narrowing opportunities for first-time buyers and younger workers. When economic risk rises, losses are softened for asset holders, while households dependent on wages face immediate consequences through reduced support or higher costs. The system stabilizes the present by borrowing from the future. Over time, this creates a form of policy lock-in. Society adapts around protecting what already exists, rather than expanding access or correcting imbalance. Economic rewards cluster where political and financial interests overlap most strongly. Social mobility slows not because ambition disappears, but because the cost of disruption becomes too high for those at the top. When policy consistently favours continuity over correction, the economy slowly tilts away from fairness and toward preservation. The result is a system that functions efficiently for those already positioned well, while quietly signalling to others that advancement requires inheritance, leverage, or timing, rather than contribution alone. This dynamic reinforces the belief that the economic game remains open in theory, but increasingly closed in practice for many households nationwide. The UK economy is not failing in a technical sense, but it is drifting away from balance. Growth continues, markets function, and employment remains high, yet the rewards of that system flow increasingly toward those who already hold assets, security, and influence. For millions, work no longer guarantees progress. Rising costs absorb pay increases, housing blocks mobility, and policy decisions quietly prioritize stability at the top over fairness across the whole economy. This creates a gap not just in income, but in confidence, opportunity, and future planning. What makes this moment different is permanence. These are no longer short-term shocks or temporary cycles. They are structural patterns shaping how people live, save, form families, and imagine their future. When stability depends more on what you own than what you earn, the economic contract between effort and reward weakens. That tension does not disappear over time. It accumulates. Understanding these dynamics is not about blame. It is about clarity. Only by recognizing how the system currently functions can meaningful debate and reform begin. Ignoring the imbalance simply allows it to deepen, locking inequality in place for the next generation. If this analysis reflects what you're experiencing in your own life, share your perspective in the comments. Like the video if this breakdown helped clarify what often feels confusing. Subscribe for more clear, evidence-based discussions on the economy, policy, and the forces shaping everyday life. And watch the next video to explore where this system may be heading next.